Welcome to the deep dive. Today we're really zeroing in on FedEx, specifically their latest earnings report, the fiscal fourth quarter for 2025. And these numbers, they land at a really interesting time for the company. They're going through some major internal changes, transformations, and the whole global picture is, well, dynamic to say the least.
Absolutely. And it's also, poignant timing with the recent passing of their founder, Frederick W. Smith, a huge legacy there.
Definitely. A legacy the team is clearly focused on carrying forward. So
Yeah.
our plan today is to really unpack these results, look at the key financials, the strategic stuff, and try to get a handle on what's driving things.
Let's do it.
Okay, so with that setup,
Mm-hmm.
how did FedEx actually do, the numbers? When we look at the consolidated Q4 results, well, despite, all the uncertainty out there, total revenue came in at $22.2 billion.
Which is up about 1% year over year. So not huge growth on the top line.
Right, exactly. But here's where it gets interesting, I think. The adjusted operating income, that grew by 8% year over year, hit $2.02 billion.
Yeah, and that's the key, right? Growing income faster than revenue shows leverage.
And the margin reflects that too. Adjusted operating margin expanded 60 basis points, so 9.1% now. And adjusted diluted EPS, the earnings per share number investors watch closely, $6.07. That's up over 12% year over year. Pretty solid.
It really is. And what's truly fascinating here, like you said, is how they pulled that off. Growing income and margin like that with only, 1% revenue growth.
Yeah. How?
Well, it's not luck. It's the direct payoff from these big strategic initiatives they've been pushing. It really shows that operational leverage kicking in.
Operational leverage. Can you maybe break that down a bit?
Sure. Think of it like tuning an engine. They've worked hard on their internal cost structure, making it more efficient. So now even a small increase in revenue or just optimizing how things run translates into a much bigger jump in profit. They're getting smarter, more efficient with every dollar.
Okay, got it. More bang for their buck, basically.
Exactly. And it's not just the profit side. Their whole approach to capital, how they spend and return money, tells a similar story. In fiscal 25, they gave back $4.3 billion to stockholders.
Wow, $4.3 billion.
Yeah, and that was actually more than the $3.8 billion they'd committed to. A big chunk of that, $3 billion, was through share buybacks.
Buying back their own stock.
Right, boosts shareholder value. Plus, they announced another dividend increase, the 5th year in a row, up 5% for fiscal 26.
Okay, so returning cash, but what about spending?
That's the other side of the coin. They really tightened the purse strings on capital spending, cut it down to $4.1 billion. That's actually the lowest it's been in over a decade.
Lowest in a decade. That's significant.
It is. And CapEx, capital expenditure as a percentage of their revenue hit 4.6%. That's the lowest in FedEx core history.
History, wow.
Yeah. And all this discipline, it feeds into strong cash flow. Their adjusted free cash flow conversion was nearly 90% of net income. That means almost all the profit they reported turned into actual cash they can use. Great sign of financial health.
Okay, those are definitely strong efficiency numbers.
Yeah.
Especially, like you said, given the wider environment. But let's dig into how they achieve that, those internal efforts. What are the key programs making this happen?
Right. So the big one, the foundation really, is their DRIVE program.
DRIVE, okay.
Yeah, and it's not just, some corporate slogan. It's a massive company-wide push on costs. They actually hit their 2-year target of $4 billion in structural cost reductions.
$4 billion.
$4 billion, yeah, relative to their fiscal 23 baseline. And $2.2 billion of that saving came just in this past fiscal year, FY25.
That's huge. How do they even find that much cost to cut in a company that size?
It takes deep analysis, ruthless prioritization, basically questioning everything about how they operate. And this program has genuinely built that operational leverage we talked about right into the business model, made them much more resilient.
Okay, so DRIVE is about cutting structural costs, and that links into Network 2.0, right? I've heard that term.
Exactly. DRIVE and Network 2.0 are very much connected. You can think of Network 2.0 as the next phase, the next leg of the transformation. It's focused specifically on the physical network.
Integrated in the networks, because they used to have separate ground and express, didn't they?
Precisely. Historically, separate networks, sometimes meaning, inefficiencies, maybe multiple handoffs for the same package. Network 2.0 is about unifying those, integrating them, optimizing how parcels physically move.
Sounds incredibly complex for a network the size of FedEx's. What progress are they making? like on the ground.
It is complex, no doubt, but they are making real tangible progress. They've fully optimized the network in Canada already. That's their biggest international market, done.
Okay, Canada's done. What about the U.S.?
In the U.S., just in Q4, they optimized another 45 stations, and they estimate that by the end of June, about 2.5 million packages, average daily volume, will be flowing through these new optimized Network 2.0 stations.
2.5 million packages a day.
Yeah, it's a significant chunk starting to move through the new system.
Yeah.
And structurally, they've closed 100 stations and integrated 290 under this new model just by the end of FY25.
So fewer, more integrated facilities.
That's the goal. The big ambition is to remove roughly 30% of their total surface facilities by the time the program is fully done.
30%.
Wow.
And the savings target?
They're aiming for a $2 billion annual benefit from Network 2.0 by the end of fiscal year 27.
$2 billion a year. But I imagine getting there isn't free.
No, absolutely not. And that's a key point. The full financial benefit, those big savings, they'll lag a bit. There are significant implementation costs up front.
Right. Things like reconfiguring buildings, retraining people, changing logistics flows.
Exactly. It's like replumbing a huge house while you're still living in it. It costs money and takes time before you see the full efficiency gains, but they seem firmly on track for those long-term benefits.
Okay. So internally, they're executing well on G-Drive and Network 2.0, building a leaner machine. But no company exists in a bubble, right? What about the external world? What headwinds were they fighting against?
You're absolutely right. Despite all that good internal work, the outside environment threw some punches. A big one was changes in tariffs, especially on the Asia to U.S. shipping lane.
Ah, trade policy stuff.
Yeah, largely driven by shifts related to China and something called de minimis rules, basically rules about low-value imports getting in tariff-free. Changes there can really mess with trade flows.
And that Asia-U.S. lane is important for them.
Hugely important. They specifically called it out as their most profitable intercontinental lane. It makes up about 2.5% of their total consolidated revenue.
Okay, so disruption there hurts.
It does. They're actually forecasting a $170 million hit to adjusted operating income just from this tariff issue in the first quarter of FY26 alone.
Ouch. $170 million just from that. What else were they dealing with?
Well, another significant one was the end of their big contract with the U.S. Postal Service, USPS.
Right, I remember hearing about that.
That created a $120 million headwind in Q4, and they expect it to keep impacting results for the first 4 months or so of fiscal 26. Losing a chunk of business like that definitely stings.
Yeah, that's the two big hits right there. Tariffs and USPS.
And on top of that, the generally weak industrial economy continued to be a drag.
Right.
It particularly pressured their higher margin B2B volumes, business-to-business shipping.
So less manufacturing, less industrial activity.
Exactly. That contributed to FedEx Freight's operating income being down 6% in Q4, even though they saw a little bit of volume improvement sequentially.
So quite a few external challenges. How do they adapt? You mentioned flexibility earlier.
This is where that adaptability really comes into play. They lean heavily on what they call their tricolor strategy. It's basically about having this flexible network where they can shift capacity and resources between express, ground, and freight pretty seamlessly depending on market needs.
Okay, so they can react quickly.
Very quickly. For instance, responding directly to those tariff-driven shifts out of Asia we talked about. In May, they cut their capacity on the Asia to Americas lane by over 35% compared to April.
35%. Just like that.
Just like that. It wasn't a minor tweak, it was a major adjustment. It really shows their ability to, flex their network muscles and reroute resources almost in real time. That's crucial when trade winds shift so fast. They're not just passively taking the hits, they're actively adjusting the sails.
That kind of agility must be a huge asset. So, okay, managing headwinds, transforming internally. Where are they focusing strategically for growth? What are the areas they're trying to build up?
Yeah, they're definitely making strategic bets. One clear area of success is healthcare logistics. That portfolio hit $9 billion in revenue in FY25.
$9 billion just in healthcare. Impressive.
It really is. And they achieved this important certification, CEIV Pharma, for their key hubs and ramps. That's a big deal in the pharma world. Validates their ability to handle those sensitive, high-value shipments. Opens doors.
Okay, healthcare. What else?
They've also formally set up a new automotive vertical, focusing specifically on the North American auto market, which tends to have high margins. Think Just-in-time parts delivery for assembly lines, that kind of thing.
Specialized high-value stuff again.
Exactly. And they're also seeing good traction in the small and medium business segment, the SMBs. Enrollment in their FedEx Rewards loyalty program was up 8% year over year. That helps lock in business from that really vital customer group.
Makes sense. Loyalty matters there. Now, beyond those specific business areas, there's this huge strategic move coming up. The plan to spin off FedEx Freight entirely.
Ah, yes, the big one.
What's the latest on that? The timing, the thinking behind it? Because separating a whole division like Freight feels like a massive deal.
It is a massive deal, and it's definitely moving forward. The current timeline is for the spinoff to happen in June 2026.
Okay, so about a year out.
Roughly, yeah. And the thinking, the strategic rationale, is really about unlocking value. The idea is that freight, which is a leader in its specific market, LTL, or less than truckload shipping, might be undervalued by the market when it's bundled inside the larger FedEx Corp.
So setting it free might make it more valuable.
Potentially, yes. As a standalone company, it could attract different investors, maybe pursue its own strategy more aggressively, without being tied to the broader complexities of the global express and ground networks. They've already named the leadership for the standalone freight company, Brad Martin as chairman, John Smith as president and CEO. Shows they're serious.
Setting it up for success post-split.
Right. And they see this separation, along with all the Network 2.0 progress, as major levers for creating value down the road. Maybe creating two leaner, more focused, and potentially more valuable companies.
And they're planning to talk more about this. Investor Days.
Yes, they've scheduled investor days. One for the remaining FedEx Corporation in early calendar year 2026, and then another one specifically for FedEx Freight in spring 2026, right before the planned spinoff.
Okay, good timing for investors to get the detailed picture. So we've looked back at Q4, looked inside at the changes, looked outside at the pressures, looked ahead at strategy. What does it all mean for the immediate future? The next quarter, Q1 of fiscal 26, what's the outlook?
Okay, the guidance for Q1, they're projecting consolidated revenue to be somewhere between flat and up 2% compared to last year.
At flat to 2%, okay.
And adjusted earnings per share, EPS, in a range of $3.40 to $4.
That seems like a pretty wide range, $3.40 to $4.
It is, and it reflects that balancing act we've been talking about. On the one hand, they expect about $200 million in benefits from the transformation programs like D-Drive and Network 2.0 continuing to kick in.
Okay, the savings are flowing through.
But offsetting that, you've got that $170 million headwind from the tariff changes.
Right.
And the $120 million headwind from the lost USPS contract business.
So internal gains fighting against external drags.
Exactly. It's kind of a push and pull dynamic in the immediate term. The internal improvements are helping, but those external factors are definitely weighing on the near-term forecast.
And speaking of forecasts, they didn't actually provide guidance for the full fiscal year, did they? Which seems unusual for a company like FedEx.
No, they didn't. And you're right, that's a notable omission. They explicitly said they're not giving full-year guidance for fiscal 26 right now.
Why not?
They cited the ongoing uncertainty around global trade policies, the tariff situation and potential other shifts, and just general uncertainty about the demand environment globally.
So, too many unknowns to confidently predict a full year.
That seems to be the message. And this lack of long-term visibility, well, it raises questions for investors. How confident can you be if the company itself isn't laying out a full-year roadmap?
And how did the market react to that?
Not great initially. FedEx shares dropped almost 6% in pre-market trading right after the earnings announcement. Yeah, it suggests that for many investors, seeing that future path clearly, having that visibility is just as important, maybe sometimes more important, than just looking at the past quarter's results, especially for a bellwether company like FedEx.
Right. So wrapping this all up then, what's the big picture takeaway for you, the listener, and for FedEx itself? It seems like a tale of two stories.
I think that's a good way to put it.
You've got this strong internal execution story, significant transformation, impressive cost control, delivering solid results operationally despite everything. But then you've got this external story of turbulence, uncertainty, shifting trade, which is forcing them to be incredibly adaptable, but also making it hard to predict the future.
Absolutely. And this really leaves us with a fascinating question, doesn't it? In today's world, which seems increasingly uncertain, increasingly volatile, how much value do you place on a company's proven ability to adapt and transform, even if it means they can't give you the traditional long-term forecast you might want?
Right. Is agility the new stability?
Maybe. You think about FedEx's journey, especially now, remembering Frederick Smith's vision. His motto was apparently, waste not a moment. And you see the company trying to live that, constantly innovating, optimizing, moving forward, even with major headwinds.
Continuously adapting.
Exactly. So what opportunities does that kind of inherent agility, that ability to flex global muscles, actually create in this kind of unpredictable landscape? Being able to shift capacity 35% on a major lane almost overnight, or deciding to spin off a whole division to unlock value. Maybe that is the key advantage going forward. It's definitely something to watch.